Okay, good morning or good afternoon, wherever the case may be, wherever you are. Thanks for joining us today. My name is Scott Smith. I'm president and CEO of FactRight. I'll have more about us in just one second, but you're joining today to talk about country club or club deals. You can also say private deals and RIAs and missed opportunities. We here think that there are opportunities for advisors to step in meaningfully to work with their clients on private programs or private deals that the clients bring to them. And we're going to dive deep into some suggestions here in a second. But before we do that, a little bit about FactRight. Please, when you have a chance and you don't know us, if you don't know us, come over and visit us at factright.com. We've been around for 12 years now doing nothing but due diligence on what we consider to be alternative investments. You can call those private investments. Some are registered investments that are also non-traded. And we've done thousands of these reviews, both at the offering level and at the manager level. You have a chance to utilize a lot of our information. If you go to our report center, you can see the registration link at the top right-hand page of our website. You can access free content from there. You can also have a discussion with us about the services that we provide, the back office diligence and compliance services to RIAs, where we're helping them walk through alternative investments that they may know, maybe not know, and help them build a suite of products or solutions for their client portfolios. So please, whenever you can, come visit us at factright.com, and we'd love to have a chat with you. But today we're talking about club deals, and we're helping the advisors out there on the call. And I don't think I need to set the stage, but I will anyway. Advisors know, probably many of you who advise high net worth clients have been presented with the following scenario, right? Over the weekend, the member event at the client's club, he was playing golf with a foursome, and one of the co-golfers had mentioned about a deal that he's invested in or about to invest in, and thought that your client should also be interested. And so your client calls you on Wednesday and starts talking about the program. Of course, advisors are faced with dilemmas at this point in one of two ways. You could either say, sorry, I don't have anything to do with those types of programs, can't help you with that, sorry, good luck, basically. Or, yes, I can go ahead and help you with that. I can step in and I have some solutions. We can go to work on that. And then you're faced with actually having to go to work and producing some kind of result. I think, and we think here at FactRight, that you can do 2 to 3 hours worth of work if you so choose. 2 to 3 hours worth of good, solid work to help your clients through a lot of these programs and to make sense of them and to make better decisions on private club deals. And that would go a long way in terms of building, obviously, the relationship with your clients. And what we also think is it's going to go a long way in potentially introducing you to new clients, because a lot of our RIA clients who use alternatives, all of our clients do, of course, because we're all alternatives-based shop, say that most of their new clients, many of their new clients at least, come from the fact that they do business in alternatives. So that's the step. And what we're wanting to do here is to help you with some of the mechanics at the back end of our presentation today, some of the mechanics of how can you assist your clients meaningfully, objectively, and looking in these programs from a high level. Again, 2 to 3 hours worth of work. And by the way, it's worth mentioning, after this webinar, at some time in the next couple of days, we're going to offer you a checklist to go along with this webinar to help you walk through some of these scenarios, some of these private club deals, so that you're not alone. You're going to have a checklist to work from. But the first order of business might be to take a look at the differences between investment advice, which is what we're going to help you do at the tail end of this, and just being an advisor in general, because we think the opportunity here is as much about being an advisor to our clients as it is to providing investment advice. And when we look at being an advisor, we probably have to think about emotions. Of course, everybody knows Bitcoin on this call. If you got in at $4,000 at Bitcoin, congratulations. If you got in at $19,000, well, condolences, right? But what we know is this Bitcoin and the value of Bitcoin, setting aside cryptocurrency and all the value that may or may not exist in those hundreds of different types of cryptocurrencies. But Bitcoin, in the last several years, took a fairly predictable trend line, rode a trend line that we'll take a look at in a moment in another scenario. But the trend line was driven predominantly from what? From emotions, right? Regardless of where you got in, if you look back as 2020 in hindsight, you can see that there was a dominant emotion in the marketplace that really drove Bitcoin. Both drove it up and then drove it back down. We also see this happening earlier, right? Back in the early 2000s, the same emotion probably drove this boom bust in terms of overriding emotions in the investor market. Those that got caught up in this, they thought this time was going to be different, right? That there was going to be a different paradigm, if you will, using a term that's overused, to support the fantastical PE ratios that were prevalent in the market during the dot-com business. This was digital marketing. This was website. Everything was going to move to the web. We know different now, but they didn't then. And simply put, it was a mania, right? It was a mania that really took hold, and it was driven by dominant emotions. And there was the mother of all manias, however, really took place back in the 17th century in the Netherlands, right, where the tulip mania. And I love this, by the way. I think this is a great. You want to go out and look for this and put it on your wall if you're an advisor, because I think this is a really cool graph showing how manias take off, go from a stealth phase to awareness phase, and then it just takes hold in the marketplace. And then you see at the top is a new paradigm, right? That's what we always hear when we get wrapped up in these types of things. And then we drop down, return to normal, and then there's fear on the way down, capitulation, then you get back to the mean. So these are all marketplace manias I've been talking about, but I think there's a driving emotion behind most of these at the individual level. And we're talking about your individual client who comes to you from a club deal. And I think there's a colloquial or acronym term that's used often today, and it's 4 words, it's 4 letters. FOMO, F-O-M-O, is taking over in these manias. And FOMO is also what's playing out in all likelihood, at least a large part of what is going on in your client's mind when they bring you a club deal, right? So fear of missing out can be explained using behavioral studies. There's been quite a bit of studies done on FOMO in the last several years. And it can be explained predominantly through risk aversion. So the loss of anything is twice as impactful psychologically as any gains are. So this has an ironic twist to it when it comes to individual behavior. The fear of losing out on anything can drive the want or the drive to be part of just about everything. You want to have a stake in everything so you don't lose out on anything. Of course, that's kind of a bombastic way of describing the private deal scenario you're faced with, but there's a lot to that in the scenario of a country club member or a co-member, a friend of a club that's presenting a deal. You don't want to miss out on it. And so while this may serve us well, it certainly serves companies like Facebook very well. Facebook has been driven by FOMO, but it serves everyone really well socially, maybe to one degree, maybe not, but it does not serve people who are investors well. It does not serve investors well at all, in our opinion. And so what we have to work through as advisors is just learning a little bit about emotional investing. You can't always divorce emotions from investing. I think some people may even say that you'll never divorce emotions from investing. It's every investment is made emotionally. It's hard to see maybe whether a long-term index fund is made emotional investing. But nonetheless, if there is emotions, and you can pretty much guarantee there is when your client comes with a private deal, you got to make them aware of it. Ask them to step back a little bit and whether, despite these emotions, if this investment is logical investment, assuming neutral conditions. Neutral being basically removing the fear of missing out from the scenario. And this is difficult, I think, for a lot of clients, because I don't think clients, particularly at country clubs, for instance, or any kind of club environment, I'm using country clubs as a general descriptor of any kind of a club environment, they don't want to rock the boat. Again, the fear of going against the grain is present, right? You don't want to be that oddball out that calls out a manager, for instance, of a particular program or of an investment as being one that's not good. So this is difficult. I think this is difficult for individuals to do by themselves, but I think it also is somewhat difficult for advisors to accomplish. But assuming we can get past that, right, we're going to fall back on objective criteria and just using analysis that's just based on basic fundamentals, right? Can we accurately describe the risk and reward formula around this offering? That is the basis of a reason why we do due diligence at our firm. We've always done due diligence in our firm under this basis, and the reason why you would want to do some level of work for your client as well. And that's where the most value is going to come from, is the information you can derive from a particular manager or a particular individual running a private deal is going to inform the risk of that program as well as the potential for return. And if that ratio is out of whack in any way, majorly out of whack, particularly in terms of more risk than any opportunity for return, then nobody's suitable for the program. Nobody is, especially your client. But assuming that ratio has a healthy balance to it, can we then just understand what those risks are, apply those risks to the tolerance level of the client, and then we can give them some better advice potentially on this. I think it's probably a good opportunity to say that, what are advisors competing against here as well? I think there's a common misperception that advisors in this scenario are competing against other advisors. And I don't think that's the case. It's not other, let me put it differently. I think registered investment advisors may think that they're competing against other registered investment advisors. What I think instead they're competing against is just a trusted source, a trusted person somewhere else in the life of that client. Here I have a picture, as you can see, of a gentleman on the right shaking hands with a gentleman on the left. Maybe the gentleman on the left knows of a program. The gentleman on the right is your client, and he's talking about that program throughout the course of the round, the golf round. You're really competing against the trust for that. You're competing for the trust of that particular client. And I think anytime, especially in financial matters, where you have an opportunity to compete for trust, is a time where you want to step in and see what kind of work you can do to help that client out, and to build your practice around that, because there's great opportunity, as we all know, in just being able to build more and more trust. Let's just step in a little bit to the actual X's and O's and how we're going to help you through some of this stuff. By the way, again, just want to reiterate, we're going to have a checklist for you. It's going to be more, a little bit more robust than the information that I'm going to provide you on this webinar. But nonetheless, we're going to go through 3 different areas that we think are probably most prevalent, or at least most worthy of a investigation by RIAs when they're looking at club deals. And again, these are high-level areas, right? So these aren't areas where you could go deep on these areas, but you don't have to. You can do some high-level, surface-level work on most of this, these 3 areas, and get in your 2 to 3 hours and come out of it with potential for good advice to your client. Now, I also want to preface this by saying this is a great contextual or pretextual approach as well. And what I mean to say is, if you can show your advisor or your client that you're doing work and here's the work that's going to be done, in many cases for these private deals, you may not get any information back from the manager on any information that you're seeking to qualify. If that's the case, then you're dealing with a pure play kind of venture capital, riskiest of all risky propositions, and there's no diligence you can do on anything like that. It's an absolute roll of the dice, and that's what you should tell your client. This is just like taking your money to Vegas and rolling it on, I don't know, blues or blacks or a red. It's not going to be something where you can qualify a risk return ratio because you're not getting any information. But at the least, you showed your client you can do work on these programs, and that's meaningful in a lot of ways. Again, it builds trust. So we'll start with bad actors. And bad actors here is an actual legal definition. It came out of the Dodd-Frank rules that were passed several years ago, probably almost 6 or 7 years ago now. Essentially what Dodd-Frank did was applied the Reg A, which is a different structure. It's kind of a registered structure, the Reg A bad actor check provision or disqualification of bad actors to the Reg D programs. And there are a lot more Reg D programs, private programs, and all of these would be issued under Regulation D, whether anybody knows it or not. There are a lot more of those out there. And so you're utilizing certain bad actor checks and you're applying it to an official check now on bad actors. And they're different than background checks. Background checks will give you good information that's worthy. They might tell you, they're going to tell you credit worthiness probably of an individual. They're going to tell you maybe where they lived or didn't live. They're going to tell you all sorts, maybe criminal convictions. Obviously, criminal convictions are you want to see those, right? Separate from any kind of bad actor regulatory checklist. If somebody's got 6 DUIs in the last 10 years or 6 DUIs at all, don't give them your money. That's pretty easy. You can kick that one out really easily. But it doesn't always give you bad actor checks in a traditional background search. And so bad actor checks are basically who's a covered person? You got to start with that. Whoever's making fees on this program, anybody who's issuing the program, they're considered a covered person in a bad actor check. And when you look at bad actor checks, what we're particularly looking for is anyone who's convicted of fraud or criminally mishandling money. If they are convicted of any of these things, either by a self-regulatory organization like the SEC or FINRA, or from any state government, federal government, they are banned from participating and getting any fees and having any interest whatsoever in these programs. And believe me when I say that there's more than a handful of these type of bad actors who are disqualified, but organizing private deals that your advisor or your clients are considering. Now, it's not easy. Believe me, we know, we've done this. And this could be a chance for you to explore, and I invite you to explore our background searches that are, in fact, both background searches and bad actor checks. If there's a bad actor who issues a Reg D, and it's come to learn that that individual took fees, the right of rescission is then owed to everybody who's participated in that program. And these are almost always illiquid programs. You do not want to force rescission on illiquid assets. So it's really critical, in my opinion, in our opinion here, that this bad actor check is done and done really well on behalf of your clients. By the way, it takes us maybe 10 days, right, to get kind of information back on this kind of check. But there are other resources out there. I don't want to just sell you on ours, but that's not why we're here. There are other resources, but it's an important check for you guys to do while you're doing your reviews. So the second piece is prior performance. Again, I get back to this idea that if you don't have any prior performance to look at all, zero, then you're dealing with a infinity amount of risk, and you might as well just tell the client that you might as well go, gamble as much as you should give your manager this money, because you have nothing to do from an advisor standpoint in terms of diligence. But there are some, if you can't get quantitative data, which in likely cases, most cases you probably can't, for instance, audited or unaudited financials on prior assets or prior funds, you can do qualitative checkups on individuals in terms of prior performance, and we think it could be just as helpful. So does the person have direct experience in actively managing or operating the assets that they're going to put your client's money into? A lot of times, a lot of the individuals who may claim to have prior performance weren't even actually invested or in operating or managing the assets themselves. Somebody else was doing it, maybe at a prior firm or under prior fund. Check deeply to make sure that this individual is in fact the one responsible for any prior performance. If they do have numbers, let's focus on full cycle investments, right? Let's focus on the manager or the individual who knows how to eliminate the biggest risk of all these programs, which is illiquidity, right? So can you actually full cycle investments? And if you can, then in all likelihood, they're sophisticated enough to have calculated returns. We want to know how they calculate those returns. Just get a sense for how the calculations have worked in the past. Do they work at the asset level? Are they calculated returns at the fund level? No, those things are very important to know when taking a look at prior performance, to see how they've done and how they've calculated the returns from the past performance. And let's narrow in on underperformance if we can. Like, especially, I would really start trusting a manager a lot more if they showed me that I did well in several deals, but I didn't do well on this one. I didn't do this well in this one because this happened. External forces went against me in ways I couldn't predict. I had a process that wasn't set up in some ways to capture. I'm using technical jargon, but you can understand how this would go. I have a process that's not set up, that wasn't set up well to handle this event, but I did take these steps when I learned about it, and it helped mitigate loss. That's really what we're looking for. Is the manager conscientious enough to stick through it? Do they have enough skin invested? That's another separate issue, but are they conscientious enough to stick through it, take the steps needed to mitigate? And then what did they learn? Because that's the most important part of any investor or any investment at all, is did you learn anything as a result of your investment? If you learn nothing, there's no gain. So that's what we're looking for from prior performance. My apologies. Here are all of I should have stepped through this, I got a little carried away, but here, once again, does the manager have direct experience actively managing or operating these assets? Let's focus full-time on full cycle investments. those that provided liquidity were really focused on that, and then narrow the focus to underperformance. What happened? What did the manager do under the circumstances? And now finally, just fee structure, very straightforward here, but look, we got to compare these fees, and this gets back to a little bit of prior performance against the manager's previous deals. You know, little changes can make big differences. I mentioned how you charge fees on assets versus funds. That little change on how the asset management fee applies, whether it's on individual assets or at the fund level, has a big difference in the amount of fees that your clients could pay in this particular fund versus the other funds. It makes a very big difference. Ask the manager how much did they make in fees nominally. What kind of fees did you make out of this program? It's really important to know in the prior performance. If they come up with a number that looks as much, if not more, than the amount of money that your clients made or their clients made or their investors made in previous deals. So take a look into this. What are the upfront fees? You've got to go through the structure here. What are the upfront fees? What are the operating fees? What are the capital fees? And can you objectively compare this to any similar investments? Sometimes you can, sometimes you can't. But run through. There are three really structures: upfront fees, any kind of acquisition fees, if there's any load associated whatsoever in these programs, operating fees, ongoing asset property manager, if it's real estate fees, any other kind of fees associated, asset administrative fees, and then capital fees, right? What's the preferred? Is there preferred return? Is there a waterfall after that? Are there clawback provisions? Things that really matter, right? And so map them out, get a sense for doing that. And if you can do that well and compare that against other investments, you're going a long way, a lot longer than most advisors on the street to helping your clients with private deals. And then just finally, just do gut check. Just gut check this thing, right? Are these reasonable or not? If they're not, kick it out. I just don't think unreasonable fees in these private structures have any place to attracting your clients' money. I mean, these are private, small, illiquid deals. If the fees get out of whack, it's just that much harder for your clients to get their money back. So here's just the big picture. We're going to wrap it up a little bit here. Didn't want to take too much of your time. And again, we appreciate the time you spent with us. But look, can the manager be trusted? We just want to know that. There's not one thing that I just talked about that didn't go to the trustworthiness of the manager. That's all we're trying to figure out here. Can we trust this manager? Obviously, you know the next point better than we do. Can your client afford to lose his entire investment? If the answer is yes, they can't afford it, then they're okay. In likelihood, they're going to be able to afford it because they've stepped in, they're high net worth, they're interested at $25,000 or $50,000. Probably usually not more than that on small deals, maybe smaller than that, but can they lose the entirety of the investment? But this is the next part that I think is even more about being the advisor. When you're connecting the investment advice, things you've learned through your diligence, to whether or not the client's actually willing to take these risks. Because there's not, unless the individual coming to you is a very savvy investor and has done a lot of this, there won't be many of these clients that come to you from private club deals that will even be able to understand what the true risks are of these programs. They just won't. Whether it's because they don't know and they're not savvy enough, or whether it's just because they're blinded by a lot of things, such as wanting to be following the crowd and get in on a deal. But they need to know, here are the risks. Now, do you know these risks? Are you willing to take them? And finally, of course, are you going to be adequately compensated for the risk? We might be able to understand the risks. They might be able to lose their entire investment. We could be trusting this manager, but the opportunity to return a 6% to 8% IRR on a real estate development ground up program isn't going to help anybody. It's certainly not going to be in your client's favor. It's time to walk away. So if we can really understand what kind of return parameters, and that has to go with your fee structure, right? It has to go with the probability of executing on strategy, because you're going to be able to look through that through prior performance. Can we know whether the risks that the individual are taking are going to be adequately compensated for through the program? And that's the end of the presentation. Look, we hope everybody enjoyed it. We hope we got a lot out of it. We tried to pack as much as we could into a half an hour. But again, I want to reiterate two things. First, come visit us at factright.com. We'd love to have a conversation with you if you're in the alternative investment business. and you have needs, problems, we'd like to see whether we have the solutions. If you have needs and problems and we don't have the solutions, we still want to hear them anyway, because we're all in this together. And then we'll have a checklist that we'll be putting together. We'll be finalizing that at the later part of this week or early next, and hopefully you'll be able to utilize that in due course to be able to look at private programs through a critical eye for your clients and do the one thing that we're here to do in this business altogether, and that's to build trust in the relationships that matter most to us. So thanks again for being part of this presentation. We will pass along this recording. We hope you have a great day and hope you have a great end of the week and the weekend. Take care now.